he will not wait for a CPR and makes a bullish candle, then it's a long entry on the first. To that, then don't take it. For that, it has to have a space for previous day high. That means target at the previous day high and stop loss below the candle or below the CPR. If previous day high is very near, then don't take it. And look at the risk reward. If the first candle is too huge candle like this, first candle is too huge, then we should not take it. Don't take it. So these are the few things, both bullish side and bearish side. Here also same, opens right at the CPR, makes a bearish candle. But look at the risk reward. If previous day was very near to this candle, then don't take the trade. Here, CPR, right? White CPR, bullish candle, stop loss below the candle. There's a good space up to previous day high, right? So you can take the. So here you can take the risk reward is good. Entry, stop loss, take profit. Here, huge bullish pin bar closed above the CPR. Keeping stop loss below the candle would be very big. In that case, even you can keep your stop loss below the central pivot for better risk reward. There's a good space for previous day high, but by the time it reached here, already you're in 2 hour, right? So previous day high is first preference. If no previous day high, you can go for next pivot or 2 hour. And this is a low probability. Why this is a low probability? Because candle opened at the CPR, closed here, and keeping stop loss below the central pivot, above the central pivot, or above the central pivot, above the CPR, huge stop loss. And where is the previous day high? Previous day high is here, right? So huge stop loss, not a good risk reward, low probability entry. And my observation for this pattern is one of the very, very less frequently happening pattern. Very rarely you will see this pattern. And even whenever it happens, you have to be very careful with looking at the risk reward, because most of the time this pattern opens with a huge bullish candle or a huge bearish candle from the CPR. Because if you have observed market charts from last few years, most of the time day's first candle is a huge candle, most of the time. So this pattern is based on the first candle itself from the CPR. So most of the time it makes a huge candle. So very rarely it makes a small candle. Then only you should take the trade, and there should be very good space till the PDH or PDL. So very rarely happens, but whenever it happens, you can take the trade and keep the stop loss. This pattern you will see very frequent. That is the GCR pattern. Here, one thing, it works best when there is a white CPR or average CPR. Average or white CPR day, it works best. What is the pattern? First candle, huge bullish candle, right? And then there is a big retracement. And when the small pin bar takes support near the first candle low, you can take a long. Stop loss below the first candle low. Risk reward, 1:2 hours should be there, or take profit at swing. Take profit at swing, I wear it reversed. Couple of things. One is it happens whenever CPR is wide or average. Another thing is that this is the responsive buyers who are active in the market, because it is not a trending day pattern. It's a sideways days market pattern. That means you will see most of the time it will go back to the day side and again it moves. So CPR is wide or average, more preferred. Here you can see that huge bullish candle started taking support near the first candle low, and here you can book the profit. Whenever you take the trade, one thing remember guys, it's all about risk reward. It's a play all about risk reward. That means stop loss should be smaller, profit target should be bigger. So when you'll get this kind of trade, whenever there is a retracement, look at this. How big is your stop loss? Look at this. If you have taken a entry here, the stop is only this much. Why only this much? Because below the first candle low, right? But where is the profit target? More than 1:2, almost 1:3. So that is why many successful traders, they make money in trading, because they don't bother about winning every time. They know that stop loss also hits sometimes, but if the stop loss hits, their loss is only this much. If profit target hits, their profit is this much. Okay? So they will not trade like a novice trader. You know what novice trader will do? He will take a long trade here. This candle. Why? Because he says, oh, huge bullish candle. He has read somewhere that bullish candle means it's a bullish sign. And he'll see that it's coming down. So that is why don't look at the candlestick, look at the location. Here, huge bullish candle, right? Wide CPR. Look at the wide CPR. Huge bullish candle where it took the resistance, CPR. And where you will take the trade? This candle. What is your risk reward? Risk is only this much. What is the reward? Look at the risk reward in this trade. One of the best trade to give you good risk reward trade, but don't look for a trending days. But don't look to have a trending day on this kind of setup, because it is for sideways days. So don't wait till 3:15, 3:30 to book your profit. Once you get a 2 hour, or once it comes near to the first candle high, book your profit. Okay. This I would say low probability. Why? Because when you entered here, there was a CPR resistance, right? Above the candle, there is a CPR resistance. So in that case, even though risk reward is good, risk is here, risk is only this much, reward is this much, but there is a CPR resistance. It's a low probability. High probability is this, where it's a wild CPR, huge bullish candle, small risk, huge reward, right? So this is called green candle retracement setup, green candle retracement pattern. This was discussed in the world webinar also. And I can say one of the very frequently happening pattern, one of the pattern you'll see very frequently. But when you take a long trade, you should know that what, for example, if this pin bar was like this, sometimes like this, then it is not a high probability. Why it's not a high probability? Because taking a long trade here, keeping stop loss, huge stop loss, right? And risk reward also not. So that's why important is where you take the entry. When you take the entry is more important. And now my observation for this pattern is, if you remember in the earlier chapter, beginning chapter, we discussed about something called when a person goes to the shopping mall, he is a smart shopper, right? He will always wait for a discount. He will always wait for an offer. He'll always wait for a bargain before buying any items during the shopping. He's a smart shopper, but same times in stock market trading, he doesn't apply same logic. The moment he sees bullish candle, big green candle, he immediately take a long trade, and then he sees his stop loss hits. He gets excited looking at the first green candle of the day, and he take a long trade. He will not wait for a discount. When he wants to do shopping, he will look for a bargain. He will bargain with the shopkeeper. He wait for a discount. He postpones his purchase if there is any festival is coming up, because he waits and sees whether they give any discounts or offers so that he can buy at the discounted price. But stock market trading, they don't apply the same logic. So this is where you can see that is magic. That means in GCR pattern, don't take a long trade immediately on the first candle itself. Wait for a retracement, because when you wait for a retracement to the first candle low, where your risk reward will be good. Your risk will be small and reward will be better. And if you have bought at first green candle high, you bought at very high price. But when you wait for retracement, then you are buying at a discount, right? So that is why apply the logic which I discussed earlier in this pattern. And in this pattern, always wait for a retracement. Don't jump into the trade the moment you see first green candle. Okay. And also, this is one of my favorite setup. Like I was telling you that if you want to trade only few setups, then I can say that this should be one of your setup amongst all these setups, where you will see this pattern very frequently happening. Same time, very high probability also. Okay. So red candle retracement pattern is opposite of green candle retracement. Same way, opposite side. That means preferably white CPR, huge bearish candle. But one thing you should remember, green candle retracement and red candle retracement, one difference is green candle retracement patterns not necessarily first candle have CPR support. But in this pattern, red candle retracement pattern, I prefer the first candle high have the CPR, then high probability. Here it's a high probability. First candle high, and then there is a CPR resistance also. So here, day opens with a huge candle, don't short, wait for a retracement. Retracement means coming back to the first candle high. There is a CPR, then a short rate, take profit back to first candle. So this is a huge red candle, right? It made a big retracement, started making a bearish sign, go short, stop loss above the CPR, take profit back to first candle. And look at the CPR, wide CPR. So high probability. This is the first candle, right? Where you will take the trade? You will take the trade here, this candle. But where will you keep your stop loss? Keeping stop loss above the CPR will be huge stop loss, right? In that case, you can keep the stop loss above the central pivot. This is also one of the high probability RCR pattern. Why? Because first thing is that CPR is wide and risk reward also good, right? Risk is smaller, reward is bigger. Where is the take profit? Take profit back to day's low. So that is what you can see, that risk reward is good in this trade, and also CPR is wide. So high probability RCR pattern. Okay, now look at this RCR pattern. First candle is huge red candle, right? And then there is a retracement. So you can see that retracement happened exactly at the first candle high and made a bearish candle. Everything is good. That is wide CPR. Yes, that is good on RCR day. And second thing, you can see that risk reward also good. Your entry here, only this much risk. Reward is back to day's low or back to CPR. Risk reward also good in this trade. But what is not good? What is not good is there is no other resistance. There is no pivot point, no PDH resistance, no CPR resistance. Because I said for this pattern, CPR resistance is most important. If not CPR resistance, if there was some pivot point, daily pivot point, or it was a previous day high, still it could have been taken, even though RCR pattern high probability CPR, but there is no resistance, right? That's why it's a low probability. But sometimes what happens, Nifty is not having any resistance, but same time, Bank Nifty having resistance here, strong resistance. So Bank Nifty reverses and Nifty also reverses. But it's a low probability because as Nifty doesn't have any resistance, right? So that is what this pattern is. Looks everything is good, white CPR, risk reward, but still it's low probability because there is no resistance above the candle where you are taking a short trade. Okay, my observation about this RCR pattern is, this is opposite of GCR pattern, but I prefer GCR pattern more than RCR pattern. Why? Because GCR pattern is a bullish pattern, RCR pattern is a bearish pattern. Most of the time, market tends to go up, right? Market direction is, on the long run, it's always to go up. So that's why GCR pattern you will see more frequently compared to RCR pattern. RCR pattern very less frequent compared to GCR pattern, and RCR pattern you will hardly see it whenever market is very bullish. Whenever market is strong in the bullish mode, you may not see RCR pattern itself for many days. So that is what RCR pattern is more common whenever market is bearish. Overall market is bearish. But GCR pattern happens more frequently compared to RCR pattern. But still, RCR pattern also high probability pattern. Next one is M pattern. M pattern is opens with a huge move, then make a big retracement. Again it bounces back to day side. Then if you see a bearish candle, you can short. Works better on wide CPR day. Works better on white CPI day. And who is active here? Responsive seller is active because he wants to take market back to value area. But only you will short if there is a bearish candle. If there is no bearish candle, instead there is a bullish candle, then you should not short. Then what is this setup? Then it is the setup which we discussed, day high breakout strategy. So that's why when it comes back to day high, look for the candlestick, whether it's making bearish. It opened here, started facing resistance at the CPR, big crash, and then started making bearish candles, and then you can take the trade. You can take the trade on this candle also, though body is not red, you can still take the trade. Why? Because of the big wicks mean it's a rejection, price rejection, and CPR is white, right? You can keep your stop loss above the CPR and take profit back to this. Here, big crash. When it came back to the first candle high, Now you will look for the shorting opportunity. Right? So very good risk reward, right? Short here, stop loss here, take profit at the this. So this is also M pattern, big crash. This M pattern is about shorting at the day side. Short here at the day side. This is perfect setup for M pattern, but low probability. Why it's a low probability? See what time it happened. It happened after 3 o'clock. So what I said after 3 o'clock, low probability. Even though it makes a good setup, don't take the trade. Okay, it's a low probability setup. And now my observation about M pattern is one of the very, very frequently happening pattern, because most of the time on sideways days, market goes up and down, stays within the initial balance. What is initial balance? First 1 hour high and low, right? So that is why this is very commonly happening pattern. But only thing is that you have to see is that this pattern should be taken only on days when CPR is very wide, not on CPR when average or CPR is narrow. Okay, so that is what you have to keep in mind. Otherwise, this pattern is one of the very frequently happening pattern and high probability pattern. But this is the pattern based on responsive sellers, right? It's not a breakout pattern that it will give huge move, but risk reward should be good, because since you are taking the trade on the retracement back to day side, your stop loss will be small and take profit would be big, right? So that is what the same pattern is, one of the high probability and frequently happening pattern. Now we are coming to the last pattern of sideways days, that is W pattern. Here in the W pattern, again, it is opposite of M pattern. Market comes down, take the support somewhere, make a huge bounce. And again, when it comes to the day's low, you can go long. You can go long on this candle, stop loss below the day's low, take profit at the swing. This is the swing high, very close. And again, here, who's the active here? Responsive buyer, right? Responsive buyer is active because he wants to take market again towards the value area. So high probability whenever it happens on wide CPR day, high probability when there is another any support, high probability if there is pivot point also. If it happens at the CPR, then also it is high probability pattern. Like this. This is high probability. Why? Market opened, took the support at the CPR, huge bounce. And you can see that again it took the support here and again made a huge bounce, came down and again it started. Take profit is back to either here, but it closed somewhere here. But still, just to show you that how to take the setup. Where you will keep the stop loss? Your stop loss can be below the central pivot. Why? Because you have two supports. One support is this candle low, third candle low, which is day's low, and the central pivot below the central pivot. So there are two supports. Here also you can see that huge bounce from here. And when price comes back to that, you can take it. Already gave you 2 hour and then again it started. So this is high probability. Why? Because there was a pivot point support and there is a day's low support. Okay. So I prefer for this pattern bouncing back to at least back to first candle high or near to first candle high. Not necessary. It has to come exactly at the first candle high. Near to that also fine. But if it happens only this much, then it's not a W pattern. It has to have a proper bounce. Okay. Okay. Here opened with a huge bearish candle and huge bounce. What is the demand zone? Demand zone is this. But it's a low probability. Why it's a low probability? Because along with the day's low, there is any pivot point or any other support, then high probability. But you can see that there is no other support, then it's a low probability. And my observation about W pattern is, this W pattern is opposite of M pattern, right? Just opposite of M pattern. But my favorite is M pattern more than W pattern. Why? Because W pattern is based on demand zone, right? When it comes back to day's low where there was a big bounce, then you have to take a long trade if there is any bullish candle. So this is based on demand zone and M pattern based on supply zone. Why I prefer M pattern more than W pattern? Because supply zone works better than demand zone. That is what my experience from last 3.5 years as a full-time trader. So that is why you see that I have a pattern called supply zone breakout strategy, which already we discussed earlier, but I don't have a strategy called demand zone breakout strategy, right? So that is why supply zone is more powerful than demand zone. So my suggestion is more than demand zone, focus on supply zone, which works better in the market. But nevertheless, W pattern also high probability pattern, because here also risk reward is going to be better because you are taking on a retracement, right? So that is why this pattern also one of the high probability pattern. But M pattern and W pattern, my preference is most of the time is M pattern. Okay, with that, we are done with the strategies for sideways days. Now we are going to last strategy, strategies for reversal days. Okay, guys, now we are coming to the chapter 9, that is strategies for reversal day. And here we are going to discuss 11 strategies. So this will be last part of strategies. First part was the trending day strategies. Second part was strategies for sideways days. And this third part is strategies for reversal day. Here I'll discuss the first pattern called open drive rejection pattern. This was there in old webinar also, where day opens with a huge bullish candle with a gap up. It looks like it's a bullish pattern which is going up, but slowly it reverses and it breaks the first candle low and there will be a big fall. So this candle you should enter. The candle which has broken the first candle low, you can enter. Where is the stop loss? Stop loss can be above the breakout line or above the breakout candle, depends on risk reward. Take profit at the previous day high or at the C. So this is called open drive rejection pattern. So what is the psychology behind this pattern? The psychology behind this pattern is people started buying here aggressively, thinking that it's a bullish pattern, and instead of going up, it started. Now, what are the things you have to look for on this day? Wide CPR. One is on wide CPR day, You will see this pattern very commonly. Second thing is that you should see on higher time frame, is there any resistance above the first candle? It may not be there on the smaller time frame, but if there's a higher time frame resistance like supply zone swing high, then most of the time it reverses. And the second thing you should look for is if there is any pivot point. If there is a daily pivot, then also it can reverse. Most important is look at the CPR. CPR is narrow or average, then it may not work. If it is wide, then most of the time it can work. Same applies on below the previous level. Opens with a bearish candle, then a small consolidation and the candle which breaks the first candle high, then you can take a long trade based on stop loss based on either below the candle or below the breakout line. Here you can see that first candle opened the huge bullish candle, started taking resistance at the pivot point, and once it has broken, you can take a short trade, stop loss above the breakout candle, take profit at the C. And what is the CPR? It's a wide CPR. Who is active here? Responsive seller, because responsive seller has seen this is above value area, so he brought it down. Back to CPR. Here also opened with a huge bearish candle, wide CPR, right? Wide CPR day, chances of trending days lower, reversal higher, and once it has broken, now you can take a long trade on this candle. Here also you can see that first candle broken the previous day high, then reverse, and broken. So all the people who went long on this candle, they had the stop loss here, below the first candle, the stop loss here. But it's a low probability trade. Why it's a low probability trade? Because this is your entry, this is your stop loss, and this is your profit target, which is just 1:1 risk reward. And what is the CPR? CPR is wide, right? Wide CPR. Okay, my observation about ODR pattern. ODR pattern is also high probability pattern, but it is not my favorite pattern. Why it is not my favorite pattern? Because over the period of time, I started preferring retracement trading more than breakout trading. Why it is so? The reason is breakout trades, most of the time you have to keep bigger stop loss because breakout happens with a full force, right? So most of the time candle will be bigger size and you have to keep stop loss above or below that breakout candle, which becomes bigger stop loss. So that is why I prefer most of the time retracement pattern, because in the retracement pattern, my stop loss is smaller and risk reward is much better. Stop loss is smaller, reward is better, right? Retracement trading is more riskier because stop loss hitting chances are more, in retracement trading rather than breakout trading. But still I prefer retracement trading because I realize that to become a profitable trader, you don't have to be right all the time. Even my 50% of the time my stop loss hits when I take a retracement trade. Still I can be a profitable trader if I follow 1:2 risk reward. And most of the time in retracement trading, 1:2 risk reward. But nevertheless, ODR pattern, I'm not saying that it's not a high probability. It is high probability. This is most suitable for people who likes to trade breakouts. And whenever I'm taking this trade, this ODR kind of breakout patterns, then most of the time my stop loss, I keep little bit bigger stop loss. So my suggestion is, even if you're taking this trade, keep little bit bigger stop loss because most of the time there can be zigzag movement. That means after the breakout, again one more green candle come, try to go up, again it can try to go up, and then again it can come down. So that's why don't keep a smaller stop loss. You have to keep bigger stop loss. So reduce your position sizing when you're keeping bigger stop loss. Or what I do it on near to expiry, like Wednesday, Thursdays, where I can keep the bigger stop loss because I get extra buffer because option selling have an edge of theta time decay. So that time I do option selling on this kind of patterns rather than option buying. Or sometimes also I can go for spreads. So what is spreads and all this? For that you can join my options course, option strategies made easy, where I discussed about the spreads. So in the spreads, you can afford to keep bigger stop loss, though your profit potential is lesser than direct buying or selling, but you can have a buffer when you're doing the spread. Okay. So that's why this strategy is more suitable for trader who want to trade only breakouts. And one more thing, you may be thinking that why this breakout patterns are in the reversal pattern. And the reason is why I kept it in breakout strategies, this pattern, because it is a reversal, right? Day opens with a bullish green candle and then reverses. Or day opens with a bearish red candle and reverses. So that's why I kept this pattern in the reversal strategies. And the next pattern is called GCPO pattern. So how this pattern is different than ODR pattern? ODR pattern is to happen only above the previous day range, either above PDH or below the previous day low, right? First candle above the previous day high or below the previous day low, then only ODR pattern. But green candle breakout pattern can be anywhere. It can be within the previous day range. Here also it looks like ODR pattern, the huge bullish candle, then small bearish candle, and once it has broken, you can take a short. And people who went long here, they had the stop loss here, all the sell order stop loss got, and you can take a short. Here you can see that this is the GCPO, not ODR pattern. Huge bullish candle, then came down, and this candle has broken. This candle has not broken actually. This candle took exact resistance near the first candle low, and this candle has broken. Now you can take the trade on this candle. Stop loss above the central peak, and then there was a huge. So same psychology, you know that you see how psychology works in the market. People went long here thinking that it's a huge bullish pin bar, and the stop loss was below the first candle low and the stop loss hit. One thing remember, in day trading, first candle, important candle, first candle, it can be bullish or bearish. First candle is the most important candle in trading. First 5 minutes candle. Always look action near that candle, near the low of that candle or near to high of that candle. Most of the action happens. This is one of the pattern which I've seen very frequently. You know what happens? Candle opens, take the resistance at the CPR. Within 2-3 candles, the first candle breakout happens, first candle low gets broken, then most of the time you can see a huge. Now, you know that this candle has broken it, but where can you keep your stop loss? Now, that is the question, right? Where you can keep your stop loss? Entering here, keeping stop loss will not be a good risk reward play, right? So, what you can do? Wait for a retest. Wait for a retest means this was the breakout line, right? This was the breakout line. So, once the breakout line broken, next candle made a green candle, and third candle again started making a bearish candle. Now, you can go short on this candle, and now you keep your stop loss here. That is what we should do. When your stop loss is big, then take a retest entry. Retest entry means when price retraces back, then you can take the retest entry. And also, if you observe it clearly, this could have been M pattern also. But you can see that it reversed from here. Had it came till here, then you could have taken another short trade because this is a supply zone because of the big crash from here. So again, chances are high that it can crash from. This is also GCBO pattern, bullish candle, and started reversing. And this candle has broken the first candle, but it's a low probability. Why it's a low probability? Because it happens inside the CPR. If the breakout happens inside the CPR, then most of the time it's a low probability. For this pattern, GCBO pattern, if breakout happens inside the CPR, don't take the trade. So this is a low probability breakout. Okay. Then what you can do? You can wait for the retrace. Either you can take the trade on this breakout candle, but stop loss will be too big. Then wait for a retest. Retest means where breakout happened, same place when price comes back, then wait for a bearish sign. For example, where breakout happened actually, breakout happened with this candle, right? Breakout happened with this candle. So you can short when price again come back near that breakout candle. So that is also one of the setup. Okay, what about this pattern, this GCBO pattern? In this GCBO pattern, I can say that this is just like a ODR pattern. Here also your stop loss has to be bigger because here also there can be zigzag move after the breakout. So you should know that compared to retracement, breakout will not be a smooth always. Breakout can be zigzag after the breakout because there can be effort to again go up after the breakout. So that is why you have to keep a bigger stop loss. So that's why when I take the trade, I look for the breakout candle. How big is this candle? Then only I take the trade. And another thing is that I prefer this when it happens somewhere within the previous day range. If the GCBO happens after a big gap down, then I don't prefer because risk reward is not in my favor. So that's why GCBO pattern, always look for the breakout candle, how big or small it is. If it is very big, then don't take the trade. If it is small, that is fine. If it is big, then what you should do? Look for a retest entry rather than directly shorting that breakout candle. Now we are coming to the red candle breakout pattern. This is the opposite of green candle breakout, not same as ODR pattern. ODR pattern happens when it happens outside the previous day range, but here it happens inside the previous day range or sometimes above the previous day high also RCBO happens. Again, same huge bearish candle, but instead of going down, it started going up. And once the first candle high is broken, you can go long. Here, entry on the candle which has broken the first candle high. But if RCBO happens inside the CPR, then don't take the trade. For example, if you see that if there was a CPR here, then don't take the trade. Most of the time it can fail. Okay. Sometimes it can also happen that RCBO happens and you see that there is no CPR resistance, but it is Nifty, it happens. Nifty RCBO happened and you take a long trade because there is no resistance. But Bank Nifty having the resistance. Bank Nifty have a CPR resistance. In that case, it can reverse. You should look at both the chart, Nifty as well as Bank Nifty chart. Here, huge bearish candle, then started making small candles, and once first candle high is broken, now you can go long. This candle you can go long, and then there was a huge candle, and another green candle took the support near the previous day high, made a small consolidation, and this candle has broken. Now you can go long on this candle. This is the low probability. Why this is the low probability? Because breakout happened inside the CPR. Though it can work sometime, but what you see here, very wide CPR, right? Chances of failure is higher. Though it went till here, then after that it stayed for rest part of the day sideways. So that is why, even though it's a RCBO pattern, but low probability because breakout happened inside the CPR. Okay, my observation for this RCBO pattern is, I prefer RCBO pattern more than GCBO pattern. For the simple reason is that GCBO pattern is bearish pattern, RCBO is the bullish pattern. In GCBO pattern, I said, if it happens with a gap down, then don't take GCBO pattern. But RCBO pattern, even though it happens outside the previous day high, with a gap up, still you can take the trade. Still it's high probability, even though it is above the previous day high with a gap up, because most of the time market trend is to go up, right? That is the one reason. And second reason, what I said, it is breakout from the supply zone. First right candle high is the supply zone, right? So it is breaking out of supply zone. That is why I prefer RCBO because it is breakout of supply zone rather than GCBO, which is breakout of demand zone. But both are good patterns. But GCBO, I said, you have to look for how big or small candle is. But RCBO works more smoothly than GCBO pattern. This pattern also was there in the old webinar called Virgin CPR reversal pattern. Virgin CPR I have already discussed. What is the Virgin CPR? Virgin CPR means if previous day was a Virgin CPR, that means there was no candlestick inside the CPR previous day, that becomes your Virgin CPR. Next day, that level will be your important resistance. Price opens below the Virgin CPR, then that level will be important resistance. So what you can do, you wait for the bearish candle, and once you see the bearish candle taking resistance near the virgin CPR, then you can take a short. Then you can take a short trade, stop loss above the virgin CPR. And it happens best when there is a wide CPR. On wide CPR day, it works best, but narrow or average CPR, sometimes it can break and start going. So that's why look for the bearishness near the virgin CPR before taking the trade. Don't just take the trade because it came near the virgin CPR. Target back to day slow or 2 hour. So previous day was virgin CPR here, bearish candle and started making the bullish. Now you can go. This candle you can go long once it makes a bullish candle at the virgin CPR. So look at this. This was a virgin CPR of previous day. Look at the wideness, how wide it is, right? So this candle you'll enter long. This candle you'll enter long, and you can keep your stop loss below the candle, and you can expect a huge movement on the upside. Here also, they opened with a huge bearish candle, but you should not go short here. Why? Because this entire range is a support. Entire range is going to be a support. So don't short here. Instead, you can go long on the second candle because it's a virgin CPR. This is a low probability virgin CPR reversal. Why? Because even though previous day was a virgin CPR, it's a narrow virgin CPR is low probability. Even though it worked, but it's a low probability because it's a narrow. If it was a wide, yes, then you could have taken a short. My observation about the virgin CPR reversal is, first of all, virgin CPR means it's an unfilled gap, right? That's what we discussed in the beginning chapters. Means most of the time price gets attracted towards virgin CPR also. So most of the time you'll see that price coming towards the virgin CPR. And virgin CPR, there are both ways, right? When bullish candle goes and makes a reversal, or bearish candle comes to virgin CPR and makes a reversal. So I've seen with my experience that virgin CPR works best whenever there is a bearish candle comes to the virgin CPR and makes a reversal and then goes up. Because most of the time market trend is to go up. Now this pattern called gap down rejection pattern. How this pattern is different than morning star pattern is when the previous day low is broken. But in this gap down rejection pattern, if there is a gap down and if it happens to a huge bullish candle, immediately first candle you can go long. Immediately first candle you can go long and keep your stop loss below the candle. Because it most of the time tends to go towards the previous day low. Here it works best whenever there is a wide or average CPR and overall market trend is up. If overall market trend is up, then most of the time you'll see that this strategy working very nice. So this is the entry on the first green candle, but sometimes you'll see that first candle will be too big. In that case, wait for second candle. Just like how OD pattern I said, you can take the entry on the second candle once first candle high is broken. Here also you can take long trade once first candle high is broken. Okay, because most of the time it have tendency to go back to the previous low. Or also you can take the support at the 20 sloping 20 because you know many times what happens when there is a big gap down, moving average will be here only, right? Moving average will be away from the candlestick. Whenever moving average is away from the candlestick, most of the time candlestick have tendency to go towards the moving average. Most of the time candlestick have tendency to go towards the moving average. Moving average is like a magnet for the candlestick. So that's why whenever I'm taking the trade, I see where is the 20 MA. For example, if I see bullish candle here, I would be interested to go long because I know that most probably it will go towards the 20 MA. Instead of bullish candle, assume that first candle was a bearish candle like this and 20 MA and 20 MA was away like this. Will I short here? Will I short here? No, it's a low probability. Why? Look at the 20 MA too away from the candlestick, right? So instead of candle going like this, chances are high that candle will go towards the 20 MA because 20 MA here. So that's why I said before the webinar, keep your notepad and pen because most of the things which I discuss here in the webinar, it is not there in the PPT. So that is something you should note down. That is tendency to go back to 20 MA. Whenever the candlestick too away from 20 MA, it have tendency to go back to that. And it can act as a strong resistance also. So if you have taken a long trade, even though you take profit at the previous day low, but sometimes you can take profit at the 20 MA also. And most of the time you see that there's a big gap down. If there is a 20 MA above the candle, then most of the time it comes and takes resistance there. Okay, look at this. This is a huge gap down, right? And huge bullish candle. But you'll get confused. Where should I take a trade? My stop loss will be big. In that case, take the trade once first candle high is put. This candle you can take it. Here you can see that 20 MA did not work as much resistance, but still it has given you good profit, right? And finally it broken and went near the previous day low. So here it's a good risk reward because first candle here stop loss below the candle, take profit at the CPR or 2. This is low risk reward. This is low probability. Why this is a low probability? Huge stop loss. Second candle has broken the first candle high, but still your entry here, stop loss here, not a good risk reward. Okay, not a good risk reward trade. So you should not have taken. What about my observation about this pattern is, this is very rarely happens because gap downs, gap ups are not commonly happens that every second day. It happens very rarely. But one thing you have to see is that what is the overall market trend? If overall market trend is very bullish, then this pattern can work very well. And another thing you have to see is that how big is the first green candle? How huge is the candle? Sometimes candle can be too big. In such case, wait for first candle high to be broken or trade with half of your position. Reduce your position size when the stop loss is very big. Another thing I've seen that when this pattern happens, first candle low is also having some pivot point or demand zone or swing low from the higher time frame, then I've seen most of the time this pattern working very well. Okay, so that is what you have to note. This is opposite of gap down rejection pattern. So how we discuss gap down rejection pattern? Same way, if market opens with a huge gap up but makes a bearish candle, then look for the short entry, take profit near the 20 MA or PDH, which is also gap border. Why it's a gap border? because this is the previous day high. Next day open here, huge gap, right? So price have tendency to come and fill the gap or take profit near the 20. If first candle is a huge candle, then you can take the trade on the second candle. Second candle, once first candle low broken. Just like how I said, gap down rejection pattern. But look at this candle, how big it is. If it's a huge candle, then your risk reward will not be good. Then you will wait for second candle to break that first candle. For example, look at this, right? Bearish candle, short entry, stop loss here, and take profit near the 20 MA or the gap border. Gap border is here. So 20 MA can sometime hold, but sometime can break also. But 20 MA is the best place where you can book your profit. Here, huge bearish candle. But can you keep your stop loss here? Even though risk reward is good because gap border is here or 20 MA is here. For 20 MA, risk reward was not good. For gap border, risk reward was good, right? But the thing is that first candle is too big. In that case, either you should short second candle when it has broken the first candle, but second candle made a bullish, third candle made a bullish. So in that case, you know what I do it? I take a small risk. I take a small risk. That is, once it comes to the 50% of the candle, once it comes to 50% of the candle, I try to short. Without even waiting for candle confirmation, I just take the short and I'll keep my stop loss. With that, even though it's a risky trade, it will give me better risk reward because my risk will be only this much, right? My risk will be only this much, the reward will be this much. So that is why in trading, it's not about trying to make profit in every trade, every strategy, fighting with the market to make money every trade. It's more about risk reward. That means taking a trade where if it doesn't work, your loss is smaller, profit is bigger. That is what the goal should be of trader, not looking for 100% win rate strategy. This is a low probability. Why it's a low probability? Look at this. Huge candle, right? Who will keep such a big stop loss? Huge stop loss. So if you see this kind of huge stop loss, where is your reward? Reward is the gap order. So this is your reward. This is your risk, not a high probability. It's a low probability trade. And my observation about this pattern is most of the time this pattern happens when they opens with a gap up and that gap up have some resistance, mostly about the supply zone or swing high from higher time frame. And from there, it makes a bearish candle and keeps coming down. And most of the time I have seen this leads to huge trending day. That means it breaks the CPR, everything, and closes at the low of the day. So that's why when you see this pattern, my advice is either book your profit at the CPR and then wait and see if CPR breakout pattern also happens. And you can again take another short trade. Because most of the time I've seen this pattern leads to huge trending day. So, but you have to see how big is the first candle. One, I told you that first candle is, if too huge, then wait for second candle to break first candle low. Or another way is, once retracement comes back to at least 50% of the huge red candle, then you can again short so that your risk is smaller. That's why I said this are not mentioned in the PPT. So you have to note down all this so that it can help you in your trading about the risk management. Okay, this is the new strategy which I not discussed earlier in my earlier webinar. That is the reverse CPR reversal pattern. What is the CPR reversal pattern? This also pattern I've seen many commonly happening, but since I did not discuss in my old webinar, I decided I'll include in this webinar. Market opens bearish, keeps coming down, and then it takes a support near the white CPR and makes a big bounce. Market opens gap down, comes up from the CPR, which loses. Here, a couple of things you should know works best on white CPR day, and it depends on how much it fell. How much it fell also makes important here. How much it fell also important, or how much it rallied also important. For example, if it opened here, it fell. Then if you see bullish candle, not a high probability. If it fell from here, then makes a bullish candle. The green candle after more red candles, back-to-back big red candles, then high probability. What is the psychology? Psychology is that people who shorted here, finally they have to book the profit, right? So people who shorted here, when it comes near the value area, they book the profit. So what you can do, you can go long. And another one is that market can't keep falling like this, right? It has to take a bounce. So most of the time it takes support at the CPR after a big fall or after a big rally. Most of the time it takes resistance at the CPR. But remember, high probability if CPR is white. Huge crash took the support and then there is a big bounce. So this is high probability, white CPR. See, it started falling from here, right? Big red candle. Though there was a couple of small candles and every small candles were getting broken. Every small candle were getting broken, right? Every small candle were getting broken by a big red candle. So where it took the support at the C. Wait for the green candle, pin bar near the CPR. Don't just jump into the trade because it came near the C. Wait for some bullish candle, right? So that's what I said. Candlestick is not important. Important is the location that I discussed earlier, right? Location is most important. Don't go long here. Oh, there's a pin bar. Don't go long here. Oh, there's a pin bar. Pin bar should be at the CPR. That also after a big crash. Here, big rally, right? White CPR. CPR is very wide. Big rally. And then made a small retracement here. Then made a small retracement here. Again, it started taking this. Now you can start shorting. When market rallies so much, it has to take rest somewhere, right? So CPR is the place which is the value area where most of the time it takes the rest. And if you see bearishness, then you can short trade because your stop loss will not be very. Your entry will be here. Stop loss will be here. Take profit at the next pivot or 2 hour or days. But this is a low probability. This is a low probability. Why? Because it started falling from here. Small fall, right? It's not a crash. Then it started making a consolidation near the CPR. But it is a low probability. But see where it went. Huge move after that, right? It's a big rally from the CPR. So that is why low probability doesn't mean that it's never works. it can also work. Like how high probability doesn't mean that every time it works. Same way, low probability doesn't mean that every time it fails. Sometime it can work. Okay. So this is a low probability on any day because fall was not. If the fall was from here, big red candle, then I would have taken that. Then I would be happy to go long here because already it fell so much, right? Okay, my observation about this pattern is, yeah, one of the very frequently happening pattern and high probability pattern. Why it is frequently happening pattern? Because you know that most of the time price goes and touches its CPR. But the main thing you have to see that how wide is the CPR. But another thing you have to see is that how much it rallied before touching the CPR or how much it fell before touching the CPR. That is what the most important to see in this pattern. But this is also very good high probability and you'll see very frequently happening this pattern. Now we are coming to one more new strategy which was not discussed in old strategy called extreme candle reversal strategy. This is one of the strategy along with GCR, RCR and all this kind of strategy where it can give you high risk reward trades. That means your stop loss will be small, but your profit can be bigger. So that means here what happens, it's like a extreme candle. That means day opens with a huge bullish candle. And many noise traders jumps into it thinking that it will go like this. But suddenly it start taking resistance somewhere. It can be previous day high, it can be supply zone, it can be pivot points. And instead of going up, slowly, reverses and make a bearish candle. In a ODR pattern, what I said, you will short first candle low. But in this pattern, you will short here only. When you see the bearishness near the extreme big first candle, but it has to be big candle, okay? It can't be small candle. It has to be extraordinary big. Some traders call it as an elephant candle. Elephant means like a huge size candle. Then suddenly there is a reversal candle pin bar. And if there is any support, demand zone, pivot point. And another thing is that wide CPR. Very important. Wide CPR or even average CPR, high probability. Narrow CPR, no, because it can keep going down from. Look at this. Here, huge red candle. Look at the red candle size. And then a green candle. Now you will go long. Stop loss here. Take profit back to first candle. Now you may ask me that, okay, how it's a high probability? Because look at the CPR. CPR is narrow. Then how it is a high probability? I said CPR is too wide. It doesn't have the wide CPR, but it met one of the important selection criteria. That is, whenever there is a huge gap down and makes a huge bearish candle, this is not place to take a short trade. Instead, looking for a reversal pattern. Why? One reason is risk reward is not good because already there is a big gap down. Another thing is that where is the 20 MA here? So chances are high that it will go to MA. Chances are low that after this big fall, it can keep going down. It can happen, but if it has to happen, then there should be some news. For example, in 2020 and all this, during the COVID time, market was crashing almost every second day, right? Such time, even though there was a big gap down, even still it was going down because there was a news, right? During the COVID lockdown, market was crashing that time. But if there is no news, then most of the time, it's a time to take a opposite reversal entry. Okay. So that is something, remember, don't short here. Instead, go long here. And one more advantage is, even though your stop loss hits, your stop loss is only this much. Profit target is this much, right? You get a very good risk reward. Here, huge candle, second huge candle, third candle, making a bearish. Huge candle, second huge candle, then it started reversing. And then it came back to the CPR. Look at the CPR. Very wide CPR, right? So chances are high that it will come back to the CPR. So what you will do, you will take a short trade on the third candle, stop loss here. So if stop loss hits, the stop loss is only this much. You take profit, you can take profit at the first candle low or at the CPR. Okay. Here, this is a low probability setup. Why it's a low probability setup? Because second candle made a reversal, but where it closed? It closed here. Can you keep a stop loss here? Such a big stop loss? No, right? And take profit here? No, right? So risk reward is not favorable. So don't take the trade. So that's why you should look for the candlestick, how big or small. Because it may reverse from here, first candle high, but if you are taking a long trade, you are taking long trade near the resistance. Even though it broken it first candle high, but you should know that it's not a high probability. What is high probability? High probability is candle like this, which will give you small risk if the trade doesn't work. You look at this small pin, right? So these are all the things very important, and it can give you very good high risk reward trade. This was not part of the earliest webinar, but this also I've seen many times it occurring in the market. So I decided I should add in this webinar. Okay, in this extreme candle reversal strategy, I said first candle has to be very big candle, very bullish elephant candles. But sometimes what happens, first candle will be medium size candles, and second, third, fourth candle like that will also medium size. So then also you can take it after 3, 4 medium size red or green candle, and then reversal pin bar, you'll see that. Then also you can take it. Why? Because if you combine 5 minutes, 3 medium size candles, then on the 15 minutes time frame, it's one big candle, right? So 5 minutes medium into 3 medium kind of candle, on 15 minutes, you'll see it as one big candle. So that's why, even though medium size candle, still you can take it, but there should be follow-up. Follow-up means after the medium, there should be a couple of more medium candles, then only you should take it. Okay, just only one medium candle, then don't take it. Either it has to be one big 5 minutes candle or at least 2, 3 medium size 5 minutes candle and then reversal candle. And another thing is that reversal candle, if it happens at some PDH, PDL, pivot points, some supply zone, swing high, swing low, such time it is high probability pattern. And also after a big gap down, such time also I've seen this pattern happening very frequently. This also new pattern which was not discussed earlier, supply zone reversal pattern. We have discussed about the supply zone breakout pattern. This is the supply zone reversal pattern. First thing is that you should be able to identify where is the supply zone. It can be 5 minutes time frame or 15 minutes time frame. It can be previous day high or previous to few sessions. But mark the level where there was a big crash. Look at the where crash happened here and where it ended here. That means there's a big seller sitting. So what you will do, you will short. You'll wait for a bearish candle and you'll short. But here few things you should remember. When it works best on white CPR day, because it's a reversal day, white CPR day, it works best. Second, also another thing you should remember, how much market. So if it has moved so much, then chances of reversal. Because I said market can't keep running, right? It needs to take some rest somewhere. And already it moved so much, then it will take a rest here. So now you can take a short. If market opened here, making a small consolidation, then most of the time breakouts are most of the time. Okay. But when I see that parabolic big movement and then comes near the supply zone, then chances of reversal high. But for anything, you should look for a bearish candle. This is a supply zone because of the big crash from here. So market opened here, huge parabolic movement, and then started reversing from here. Now you can take a short trade on this candle, stop loss above the supply zone and 2R or back to C. And another thing I've seen with my experience being in the market, that supply zone, demand zones and all, they work like a magnet on the chart. For example, you see that there is a supply zone, there is a pivot point here, and there is a supply zone. So you can see that it came near the pivot point, but it went and touched the supply zone and then it came, right? It did not come down from the pivot point. So that's why whenever you want to take the trade, if there is a pivot point and supply zone, you should know that it give more importance to supply zone rather than pivot points. Okay, this point to be noted. Supply demand zones are more powerful than even the pivot points. If you ask me, importance wise, what I give more important? I give most important to CPR first. Second, my most important, I give it to supply zone. Okay, importance wise. And then other things. More than demand zone, I've seen supply is working much better. So that is what you should note down, that just to focus on supply zone, guys. If you think that's difficult to remember all the pattern strategies initially, then only focus on supply zone. Mark all the chart where there is a supply zone and see how it works on Nifty Bank. Okay. Remember, this webinar is mainly for Nifty Bank Nifty, not for stocks. Stocks, I have a different method, different strategies that you can see in my website about that course details. But this course is for Nifty Bank Nifty, where most of the time supply zone can work very well. Focus on supply zone because if the trade works, you can make a bigger profit. If trade fails, your stop loss will be smaller because risk reward is very good. Here also you can see that big crash, and this kind of crash I like. Why I like this kind of crash? I like this kind of crash. That means huge sellers here. And where it started from? What was the main point it started from? It started from there. What you will do? You will mark a horizontal line and you will wait for price to come to that level. And once you see the bearish candle, you will take a short. Look at your stop loss this much and look at the profit target, right? If the trade fails, yes, your stop loss hits, but still your stop loss can hit, but your stop loss will be only this. Here also you can see that big crash. So this is your supply zone. But can you see that this kind of first candle only touched the supply zone? But can you short this candle? No. It's a low probability entry. Why it's a low probability? Because candle closed right at the CPR. Can you short here? No, right? Where will you keep your stop loss? Can you keep your stop loss above the supply zone? Because in this pattern, most of the time your stop loss should be above the supply zone. Huge stop loss. Don't take the trade. Leave it. Only if price comes back and makes another bearish candle, then you can take the trade. If the candle is small. So it's a low probability trade. About this supply zone reversal pattern, one thing what I've seen many times, what happens when price comes near the supply zone, it start making a consolidation with small green candles, pin bar, doji and all this. And it will give an impression that now there is going to be a breakout. And many people, they just take a long trade before breakout happens. They just take a long trade anticipating a breakout. Why? Because they think that after the consolidation mean it will breakout happens. It is true also, after the consolidation, most of the time breakout happens. But what I've seen many times, it makes a consolidation and give an impression that it is going to break out soon and suddenly there will be reversal. And this is also one of the very high risk reward trade can give. That means if the stop loss hits, it can hit a small stop loss, but if it reverses, it can have a massive fall. It's not a breakout trade, it's a reversal trade, but still from the supply zone, again it can reverse. And another thing, remember, this is applies for all supply zones. Whenever price retests the supply zone, first time or second time, high probability reversal happens most of the time. But again and again it comes back to the supply zone. After 3 times, 4 times, 5 times, then more than reversal breakout happens most of the time. It applies for demand zone also. Supply or demand zone, whenever price retest again and again, chances of breakout is higher. When it comes first time to any supply zone or demand zone, then chances of reversal is higher. This you can note down in your notepad. Gap order rejection pattern. So what is this gap order rejection pattern? See, this gap order rejection pattern is where price once comes to the gap order, if makes a bearish candle, then you have to take a short trade. That is, you have to take a short trade once you see the bearish candle near the gap order. So let us see some examples so that you will understand better. This is the gap order, right? Next time market opened with a gap. Now look for the gap order and look for the candlestick. If candlestick is making bearish, go short. Stop loss above the gap order. Take profit at 2R or back to first candle. But the important thing is that it has to make a bearish candle and works best when CPR is white. Market opened with a kind of doji candle, came down, and then it went to gap order. So this was the gap order, made a small reversal bearish candle. Enter short here, stop loss here, and look at the take profit. 1:2 risk reward. Okay, this is the another example of gap order rejection pattern. You can see that previous day was a kind of volatile day, right? And this candle made a huge wicks here, right? And then made a big bounce. Next day, what happened? Next day, you can see that this candle opened almost at the this wicks, right? Which is the gap border. So what is the gap border? So this is the gap border, right? It opened almost right at the wicks. It opened almost right at the gap border, right? So that time it's a low probability. Why it's a low probability? Because at least if it opens somewhere below the gap border, then it can go here and then it can face the resistance. But you can see that candle open almost at the gap border. So such time it's a low probability. Though it worked and gave a huge move, risk reward was also good because shorting here this candle, keeping stop loss above the gap border, and it broke on the pivot and gave a big profit, right? So that's why low probability pattern mean it can give the profit, but it's a low probability because it opened almost at the gap. It has to make a small gap down. For example, this has made some gap down. It opened somewhere here and then it went till here and finally it took the resistance. That is okay. This also you can see that though it opened somewhere near to gap border, but not exactly at the gap border. It made a huge wicks on the downside and it got rejected. So before reaching the gap border, how much it moved? It moved this much, all right? So this much movement before reaching the gap border. So this you can take it. But this is low probability because candle opening here, gap border is here, and it only made this much move. Had this candle made a huge wicks like this, then you could have said that from the low of this candle to gap border, it made a this much move. But you can see that this candle almost opened near the gap border and made a small bearish candle. So low probability. Okay, my observation about this pattern is it is high probability, but very rarely happens this pattern. Because for that matter, any pattern which gap up, gap down, those patterns are rarely happening pattern because you know that gap ups, gap downs doesn't happen every second day, very rarely happens, right? This pattern I've seen works well from opening till mid-afternoon. Late afternoon, I've seen this pattern doesn't work so well. Most of the time, late afternoon breakout happens. So if you see this pattern happening at the opening or mid-afternoon, then you can say it's a high probability. So what is a fake breakout pattern? Fake breakout pattern can be traded as a SAR. If you don't know what is SAR, SAR means stop and reversal strategy. That means you will take a long trade, your stop loss hit, immediately you will take your stop loss and you will reverse your position. That is called SAR, stop and reversal. For example, this candle has broken the day's high, right? This was the day's high. This candle has broken the day's high. And many people went long. And what happened? It reversed. So people who went long, who kept the stop loss below this breakout line, the stop loss to go. What you will do it? If you have taken a long trade, you close your position because your stop loss hit. Here you are long, right? Now you will take a short. Now you will take a short trade, right? That is called stop and reversal. That means you went long, your stop loss hit. One stop loss hit, you are taken a short position. And this is a fake breakout. This is what happens many times because it makes you feeling that, oh, it's going to go up and it reverses. And when it happens very frequently, when CPR is very wide. Wide CPR day, fake breakouts are very common. But here, remember, in this fake breakout pattern, it's not necessary every time it has to break the day's high and then reverse. It can be like this, right? Like this, breaks the day's low and immediately reverses, then you can take a long. Not every time it has to be breaking the day's high. It can be breaking the day's low also. And another thing is that if reversal happens immediately in the first few candles, then high probability. If reversal happens very late, that means breakout happened, it kept on going up. Then after some 1-2 hours, then it broken, low probability. It has to happen immediately, then high probability. So this is not every time it has to be day high resistance breakout, fake breakout. It can be previous day high fake breakout. It can be supply zone fake breakout. Not every time it has to be day high resistance. It can be other resistance also or other support also. For example, first candle opened bullish, started going up, and this candle has broken the first candle. Immediately it crashed, immediately started reversing. This candle you go. This candle you go long because this is a fake breakout, right? And where will be a stop loss? You can keep the stop loss below the breakout line, take profit back to this. Okay, now we are coming to the second example of fake breakout pattern. First, look at the CPR. CPR is wide. So what you are expecting? You are expecting a sideways, right? Where is the first candle high? First candle highs, and there is a CPR resistance. But you can see that this candle has broken the CPR resistance and first candle high, right? First candle high and CPR both were broken from this candle. And many people may try to take a long trade thinking that it's a breakout. But what you should see is the white CPR. So white CPR day, very less chance of breakout. Fake breakouts are more common. So what you will do? You will not go long here. You will wait for the fake breakout. And this is the fake breakout. This candle will short. And stop loss above the swing high. Take profit can be back to this. So that's why I said fake breakout means if CPR is very wide, then you will not even take a long trade here because breakouts are most likely to fail because CPR wide. Even if you have taken a long trade because CPR was broken, what you will do once candle reversed, immediately you will take your stop loss and you will reverse the position. That is what I said, stop and reversal. That means this trade you went long and immediately you close the position and you take a short position on this. So that is why this pattern very commonly happens. And by knowing the wide CPR, many times it can help you by not taking a breakout trade because you know that breakout's likely to fail. And another thing what I said, if the breakout happens immediately, here you can see that second candle only breakout. If breakout happens immediately within few candles, then it's a high probability. Okay, now let us look at the third example of fake breakout pattern. They opened with a huge bearish candle. It was a gap up. Then price started going up First, it started facing resistance here at the first candle high, and then breakout happened. This candle made a breakout. So then it went till here and then reversed, and this candle made a fake breakout. This candle made a fake breakout, and then it went all the way, and finally it closed at the day's low. That was the almost first candle, all right? But you know what? This is a low probability pattern. Why I'm saying this is a low probability pattern? Because if you remember, earlier I said, if the fake breakout happens very fast, very early, immediately, then it's a high probability. If it happens a little bit late, after like 7-8 candles, then it's a low probability. It can happen. For example, how many candles? Candle 1, 2, 3, 4, 5, 6, 7, 8 candle made a fake. So it's a low probability. So that's what I said. If there is a resistance, if candle goes like this and for almost like 1 hour, 1.5 hours, after that finally fake breakout happens, then it's a low probability. If it goes up, immediately reverses, then it's a high probability. So it happened almost after how many candles? Almost 8 candles, right? So it's a low probability fake breakout, but still it worked. And one thing you see that, how price actions are known as a supreme in trading. For example, look at the entire day of this chart. Only huge red candle was this, and second huge red candle was this, right? After that series of red candles. So what is the reason that is this is a huge red candle? Why not any other candle here? That is for the reason. It is not just happened like that. Because people who went long here after the breakout, they had their stop loss below the breakout line, right? Below the breakout line. What is the stop loss? It is sell order, right? They thought it's a breakout, it will go like this. So that is what you can see in the price action. So that is what price action called as a supreme in trading. For example, look at this. Breakout happened and then fake breakout happened with a huge red Maribozu candle. Why? Because there were huge stop loss below this breakout level, right? And once all the stop loss got triggered, all sell order got triggered. Here also you can see that once price reversed, huge green candle. Why? Because people thought after the break of first candle low, there will be huge move and they started keeping stop loss. What is the stop loss? Buy order. So that is why you can see that huge candle because most of the buy order got triggered. So that is how price action, if you observe it clearly, it will tell you some story. Okay, fake breakout pattern is the last and 25th pattern, right? So you must be having a question. I've discussed so many patterns. I've already finished 24 patterns and now we have come to 25th, which is my favorite pattern, right? Everyone will have their own favorite pattern. So there are many patterns which are my favorite pattern out of 25. Out of that, one pattern which is my most favorite, and that is fake breakout pattern. Yes, my most favorite pattern, I have kept it at the last, that is on 25th. This is the fake breakout pattern is my favorite pattern. I'll tell you one thing. When I was preparing this presentation, I was looking for the chart example, right? I have to give the chart example for every pattern. But when I was looking for fake breakout, I was getting so frequently fake breakout pattern. So many fake breakout pattern charts I was getting from trading the chart. So that itself an indication that fake breakout patterns very frequently happens in the market. And the second thing is that it will also give you very good risk reward trade. But only challenge with this fake breakout pattern, you should know that is sometimes both sides stop loss can get hit. That means you have taken a breakout thinking that it's a real breakout, but it reversed and your stop loss hit. What you have done? You have reversed your position and you have taken a fake breakout trade. But what happens? Even the fake breakout also again it reverses and again it goes up. So both sides your stop loss hits. First trade your stop loss hits. You have taken a second trade thinking that fake breakout will give you profit, but fake breakout also reversed and that also stop loss hit. That means back-to-back stop loss. So that's why you should be comfortable in taking stop loss. If 2 back-to-back stop loss hits in any day, that means you are done for the day. Close your system. Don't take any more trades. And that is what I do it. If my both back-to-back stop loss hits, then most of the time I prefer not to take any more trades. So that is my advice to you. Don't fight with the market, but still it is one of the high probability pattern and you'll see it very frequently. Okay guys, with this we have finished all 25 patterns and we discussed strategies, right? So for people who attended my old webinar, you must have got some new strategies this time. And I've discussed some more things which I've seen in last 3.5 years as a full-time trader, right? Earlier I was not giving observation. Earlier I was only telling you about the patterns. Now I can give you observation also because I spent almost 3.5 years being a full-time trader. Now what changes I've seen from my first webinar to now the current webinar? What are the changes I've seen in the market? One big change I've seen is that volatility has increased in the market. When 2019 I started full-time trading, this much volatility was not there. So when volatility increases, what happens? Your stop loss can get hit very frequently. And if you keep bigger stop loss, then you will not get risk reward. So what I started doing is that along with buying option or selling option, I started doing spreads also, bull spread, bear spread, where you have a flexibility of stop loss. And also I started doing strangles, straddles, other option strategies also I started applying. But what edge I have is by trading Nifty Bank Nifty for last 3.5 years is most of the time I can analyze the market direction. Before market opens, I can visualize what is likely to happen in the market. Even after market open, after some half an hour or 45 minutes, I can identify whether it will be trending day, reversal day, or a sideways stage. And I can apply my option strategies accordingly. If I see that it's going to be purely trending day, then I will not apply any option strategies. Either I will buy option or sell option, or I trade in futures. But if I see that there could be zigzag movement, then either I'll go for spreads, full spread or base spreads, or I'll go for strangle and strike. So that is what I have started doing it, which I was not doing earlier, 3.5 years back. I was purely direction-based trader, only buying option or selling option or futures. But after that, I started using other option strategies also. So that is why my suggestion is don't be purely on option buying or option selling or trading futures. Learn option strategies also, because by trading Nifty Bank Nifty day in and day out, after some time, you'll get that knack of understanding the Nifty Bank Nifty direction, which side it is going, whether it will go trend or sideways and all this. But still your stop loss can get hit because of the volatility, right? And you'll get upset that even though your direction is right, your stop loss got hit. So that's why my suggestion is learn other option strategies also. And another thing is that what change I have made in last 3.5 years, that when I launched my first webinar, I was a big fan of breakout trading, like RCBO, GCPO, ODR pattern and all this. I was very big fan of breakout pattern. But recently what changes I have done is, from the breakout trader, I started using more of retracement trades. More of trades were taking on retracement. So that gave me better risk reward trade. I'm not saying that every time I'm winning, my stop loss also hits. But when I take trades based on retracement, my stop loss is always smaller and the trade hits target, my profits are big. Okay, now coming back to 25 patterns, which I discussed now. Many of you may be wondering how to remember all these 25 patterns. It's too much, right? Remembering all 25 patterns. For that, I have a suggestion for you. Don't remember all 25 patterns at one go. Try to remember one pattern in a day. That means today, first pattern, tomorrow, second, day after third, like that, you should remember. And how you will remember? By practicing. How to practice? Do the backtesting. Do the backtesting on historical charts. Go to Nifty Bank Nifty last couple of years charts and start doing that pattern by pattern. For example, OD pattern. Start identifying OD pattern in last 2 years, when it happened, when it worked, when it failed. Everything you have to see. That is how you will remember patterns. Now you may have a question that trading you offers only last 4, 5 or 6 months charts on 5 minutes time. After that, you'll not get 5 minutes time frame. You have to increase the time. But all the patterns which I discussed, most of them are 5 minutes, right? For that, if you want last 3 years historical charts of Nifty Bank Nifty, send me an email asking for the historical charts, and I can give you Nifty Bank Nifty last 3 years historical charts. So you can send me an email and I can send a Google Drive link, and you have to download all the charts and keep it in a folder. So that is only for people who request for it and who are really interested to learn more by doing the backtesting. And second thing is that in this webinar, like earlier, there is no ebook, but you can request for a PPT, which you can keep it for reference. You can send a mail requesting for PPT. And also there is a limited period of access where you can watch the videos again. And that is how you can remember all 25 patterns and strategies. Okay, guys. So that's it about the strategy section. Next, we are going to risk management and trading psychology section.